Good afternoon, everyone. Thanks for joining us for our webinar, All Change for UK Accounting. My name is Alex Peel and I'm Head of Audit and Assurance at James Cooper Creston. And today I'm joined by one of my partners, Alan Poole, who's also an Audit and Assurance partner at the firm. And our agenda for today really is to look at the changes in UK financial reporting, UK company accounting, and look at what's going to be happening over the next year or so, look at some of the key changes compared to how accounting used to be done in the UK, looking at the tax implications of some of those changes. We're going to have a brief look at the new accounting regime for smaller companies, although more of that to come, and then have a look at sort of the things that need to be done in respect of implementing the changes. The first thing we thought it would be useful to do, though, would be to have a look at our audience and find out what people's current experience are. So shortly you should have a poll on your screen which will allow you to indicate what you currently use in respect of the accounting standards for your company or your business, or if you don't currently have a company or a business, what you're most familiar with. And that will just give us an indication of the type of audience that we have today and the different people and different experiences that you have. So we'll let that run for a couple more seconds. I think votes are coming in now. Hopefully everybody can see that. That'll help us to talk more directly to the people who are attending today. So I think the results of that show that most of the audience today are using full UK GAAP at the moment. Some experience of financial reporting standards for smaller entities in the UK, a couple of people on international financial reporting standards, and some people on some other standards, which is sort of where we thought we were pitching it. So that's good for starters. Okay, so as many of you will know, over the last few years, there has been a convergence towards more consistency with international financial reporting standards. For about 10 years now, listed companies have been required to use IFRS, and there's been a move to bring UK standards into line with IFRS. 3 years ago, various new standards were published. They all start from FRS 100, which is the general principles. And the standards that will be the standard which we'll be talking about mostly today will be the new standard, Financial Reporting Standard 102. There's some others as well, though, and I thought it'd be worth spending a couple of minutes just looking at those other ones, just so that people know what they are and where they fit in. You might wonder why we start with Financial Reporting Standard 102 or FRS 102. FRS 101 comes before that, and whilst it's an accounting standard in its own right, it's probably not going to apply to the majority of UK companies. FRS 101 allows the adoption of IFRS, but without many of the extensive disclosure requirements. It applies to certain qualifying companies where they're subsidiaries of a group where the group accounts are made available to the public and include the subsidiary in the consolidation. So FRS 101 might be useful for some companies, but probably not the majority, and that's not what we're going to spend most of our time on today. Going forward, companies still will have the choice as to whether to use full IFRS as adopted in the EU. That's still an option. Again, this isn't a webinar about IFRS, although obviously what we will do today is contrast some of the rules in the new UK accounting standards with IFRS. Another standard you might come across is FRS 105, and FRS 105 was issued in July this year and is going to be the new accounting standard for what's defined as micro entities. Now again, we're not going to focus on this today. A micro entity is defined as something with broadly turnover below about £600,000 and fewer than 10 employees. Again, we'll come back to that. There's a couple of others as well. Unless you happen to be in a particularly specialist business, you probably won't come across them. So, for example, FRS 103 relates to insurance contracts, and FRS 104 relates to interim financial reporting. Again, detailed rules for specific circumstances. The key thing, though, is these new financial reporting standards will supersede all other UK GAAP. So the various standards that a number of people, certainly in the accounting profession, have grown up with, so the SAPs, existing FRSs, urgent issue task force notes, all get replaced and subsumed into the new UK GAAP. So just a bit of brief information on FRS 102 then. As I mentioned, it's a fundamental rewrite of UK GAAP. It aligns the UK accounting processes and systems with IFRS, but there are still some important differences which we'll look at. As mentioned, it replaces UK GAAP for all medium and large entities unless they're using IFRS. So the standards that have been used by medium and large companies and entities in the UK will go. It will impact small companies, albeit with perhaps a bit more limited impact. And as I mentioned, micro organisations, micro entities will use something FRS 105. A brief outline then of when you will be affected. We'll come onto this in more detail later on in the presentation. But essentially this starts with periods beginning on or after the 1st of January 2015. So we're already into it, and probably the entities with which will adopt it first, unless you're running a short period of accounts, will be those with 31 December 2015 year ends. The prior year in your set of accounts will get restated in accordance with the new rules. So if there are changes to the way your numbers are worked out, last year will also be changed. And it's important to know something called your transition date. More of this later, but some common year ends and first periods and transition dates are shown on the screen at the moment. As I said, we'll come back onto that more later. So looking at how you'll be affected, there are going to be some significant differences compared to existing UK GAAP, which obviously could affect your reported profits in the UK in your accounts. That in turn may not matter too much, but it may do. Obviously, you might end up paying more tax as a result, less tax as a result, might have less of an ability to pay dividends out perhaps than in previous years. And if you have bank covenants, they could be affected by the results that you're reporting. Regardless of whether your numbers change, though, there will be changes to the format and the content of the accounts. So what you get will look and feel very different in future years. So before I hand over to Alan, who's going to talk about some of the key changes, I thought it'd be interesting to ask, based on what you know so far and based on knowledge that you might already have, do you think that your profit will increase, decrease, or stay the same under the new rules? Now, I appreciate that you may not know enough about this yet, but I thought it would be useful at this stage to ask the question. So you should see the poll on your screen now, so do please now vote. I think we're getting there. Most people have voted. 5 more seconds. Okay, thank you very much. I'll now hand over to Alan.
Thanks, Alex. Yeah, so I'm going to run through most of the key changes between existing UK GAAP and FRS 102. It's interesting, the results of the poll are in, and the vast majority of people are saying that that they expect their profits to stay the same under FRS 102 as under existing GAAP. Small number of you think they will decrease, and a smaller number still think they will increase. So let's see. As I work through the next few slides, in the main I'm going to be comparing against existing UK GAAP, but I will also refer to IFRS once or twice when that's of interest. So we're going to start with Goodwill, and that's actually the area that's probably had the most talk in the press around the change to UK GAAP. But actually, to a large extent, it's a bit of a red herring. The changes aren't anywhere near as significant as seems to have been thought in the market, or at least initially. Ultimately, the new rules are the same, in that Goodwill will continue to be amortised over its useful economic life. There are, however, two specific changes. Firstly, all Goodwill will now be deemed to have a finite life. Previously, it was possible to consider Goodwill to be indefinite in terms of its life and therefore not amortised, if and when that could be justified, but probably quite rare circumstances. The other change, and this is the one that really gave rise to the noise, is that where the useful economic life of Goodwill can't be reliably estimated, the assumed life, or the deemed life, is much shorter under new GAAP than old. So previously, if it was impossible to reliably estimate, the default period was 20 years, so a pretty long period. Under the new rules, it's going to be 10 years, and actually, bizarrely, just for 2015, it will be 5 years, because the first cut of the new standard, so to speak, set a default of 5 years. That's been superseded now to 10 years, but the new version doesn't apply until 2016. So a bit bizarre in that you might in the past have amortised over 20 years, you'll then have a year at 5 and then revert to 10. But it's really important to remember all of this only applies if you can't reliably come up with a specific life for your own Goodwill. So if the Goodwill on your balance sheet has a life of 20 years and you can sensibly justify that, then it's absolutely fine to continue to amortise it in that way. And that's really why we think it's not such a big deal after all. It contrasts hugely with IFRS, interestingly, because in general, FRS 102 moves towards IFRS, but in this case, completely away from it, because IFRS actually doesn't have any amortization of Goodwill at all. So it just sits on the balance sheet and gets reviewed for impairment each year. In terms of the transitional arrangements, they're not retrospective, so the change to a shorter life, if that's what you do, will apply only from the transition date forward. You do not need to go back and restate previous periods. Okay, so the next area I'd like to cover is business combinations, or acquisitions and mergers, might be a more familiar term. It's quite a complex area, so we're only going to focus on the key points. Really, you could do a 30-minute webinar on this alone. The main difference is greater recognition of intangible assets under acquisitions. And what I mean by that, under old or existing GAAP, really, in calculating Goodwill on an acquisition, it's really just a case of taking the balance sheet that you've acquired, possibly doing a couple of fair value adjustments. For example, if there's properties on the balance sheet, they might have a different fair value to book value. But typically, it was just a case of comparing the cost of the acquisition with the acquired balance sheet, and the difference was Goodwill. But under the new GAAP, it's quite different. So, and this is in alignment with IFRS, in that we now need to dig into that Goodwill and look for the assets that make it up. So these will be things like brands, all sorts of intellectual property, customer lists and contracts, things like that, which previously were just subsumed into Goodwill. They will actually now be separately recognised on the balance sheet as part of the acquisition accounting. And these will often have a shorter useful economic life than Goodwill. So, and that's, I guess, where it matters, in that things like IP could be just 2 or 3 years of life and get written off quite quickly, whereas Goodwill would have been written off rather more slowly. So that's likely to impact profits in the short term, and could be very significant if you've done significant acquisitions. It's also, frankly, more work, because we're going to have to go in and dig out those intangibles, get them valued, possibly by a professional expert. Something like a brand is quite hard to value for a layman. So it's more work and more cost potentially. It's worth mentioning quickly that acquisition expenses continue to be added to the cost of acquisition. So that's things like legals, due diligence costs, etc. Under IFRS, those now get expensed, but under the new UK GAAP, as with old GAAP, those do still get added onto the balance sheet and effectively form part of the Goodwill. There are lots of other changes, but they're subtle and they'll apply only in a minority of cases, so don't want to spend time on those now. Just worth a brief mention of the transitional arrangements, though. and that is that on first adoption, any acquisition that has occurred since the transition date, and Alex will revert back to transition dates later, but essentially if you've got a December 15 year end, for example, any acquisitions in 2014 or 2015 will need to be reworked under the new standard, but ones previous to that can be left as they are. Okay. Moving on to a couple of pretty straightforward changes now, but ones that will apply quite widely. So lease incentives, this is, for example, where a lessee takes on a new property and is given let's say, rent-free period as an incentive to sign up to the lease. Under old GAAP, the effect of those incentives, in effect, is a reduction in the overall rent cost, was spread over the period of the first break in the lease. And typically in the UK, we'll have maybe a 10-year lease with a 5-year break. So that incentive would be spread over the first 5 years. Under the new rules, it's spread over the whole lease, unless you can objectively show that you intend to break, to exercise the break, because in effect that means it's a shorter lease. But that aside, it's going to be spread over the whole lease. And again, this applies to new leases since the transition date. So again, with the December 15 year end, any new leases since January 14 would apply. The next slide just has a little example to hopefully bring that to life. So what we're talking about here is a 10-year lease with a 5-year break, and the lessee has been given a rent-free period which equates to a 50,000 reduction in the rent. Under the old GAAP, that 50,000 would be spread over the first 5 years of the lease, reducing the rental charge to the P&L by 10,000 per annum. Under the new rules, it will be spread over the full 10 years, so reducing it by just 5,000 per annum. So all in all, over the entire life, same result, 50,000 benefit, but spread more slowly under the new rules, and therefore a reduction of profits in early years and an increase in profits in later years. On to holiday pay, another fairly straightforward one, but likely to impact quite widely again. Typically in the UK, businesses haven't accrued for holiday pay. Some do, often if it's an opportunity to reduce the tax bill, but typically most businesses don't do that. On the continent, it's widely done. Under FRS 102, it has to be done, unless it's immaterial. That goes for everything though. If it's immaterial, one doesn't have to do it. A liability can arise from two things. Firstly, if your staff are allowed to carry holiday over from one period to the next, that creates a liability for that future cost. And also, if the holiday year doesn't match the financial year, and that's often the case, in our experience, most UK companies use a calendar year for their holiday, even though their financial year is likely to be something very different. So again, that mismatch can create a liability. I think probably if you've got a year end in the sort of late spring or early summer, particularly June could be a problematic period for this, because people tend to take a lot of holiday in July and August, also in December for Christmas. So you tend to get a lot more holiday taken in the second half of the year, so that could create a significant liability, which may be a good thing because it could reduce tax. But a bad thing, obviously, if you're interested in posting good profits. Okay, so on to investment properties. There's quite a number of changes on investment properties, but we'll just run through them quite briefly because it's going to impact a minority. There's a slightly wider definition of what an investment property is. In essence, previously, if a property was used anywhere within the group, it would not qualify as an investment property. But now, if a property is held by one company and used by another company in the group, which is quite typical because large groups tend to have a separate entity to hold their property, that will still qualify as an investment, or sorry, it will now qualify as an investment property. The main change, so I'm seeing a couple of changes come through. A couple of questions come through. I think what we'd like to do probably is deal with those at the end, if we may. So we'll just cover those off when we get to the end, please. The main change on investment properties is that changes in the valuation will now go through profit and loss. Previously, those were just sort of balance sheet changes that went through the struggle, those of you who are familiar with what that means. But now these now affect reported profits. So it's going to certainly increase the volatility of reported profits for those entities that have investment properties. I guess in the long run it's going to go upwards, but you know, things will go up and down and just create greater volatility. We're also, for the first time, recognising deferred tax on revaluations of properties, including investment properties. There are a number of other changes, but again, they're not going to apply to many, so we'll skip over those for now. I'd like to focus on one of the key transitional rules, and that is what's known as fair value as deemed cost. And what that means in simple terms is there's a one-off opportunity for preparers of accounts when doing their first year's accounts to take assets that are on the balance sheet at cost, for example properties and plant and machinery, things like that, and revalue them to fair value as a one-off exercise, but then treat that fair value as cost going forward. So a couple of key examples. You may have a property on your balance sheet that's not an investment property, so is at cost. You've held it for 20 years. It could be worth 10, 20 times what it's actually in the books at. That can be brought in as a one-off boost to the balance sheet, but it doesn't commit you to then having to do periodic revaluations going forward. So that's quite a nice opportunity to boost the balance sheet. Similarly, things like plant and equipment and vehicles, if they're worth more than they're carried at, they can also be boosted up to the fair value and then just depreciated going forward, but in the normal way. So it just gives a one-off opportunity to strengthen the balance sheet without committing to revaluations going forward. Okay, we'll touch briefly on financial instruments. Those who are familiar with IFRS will be aware that financial instruments is a pretty painful area for accounting. The bad news is FRS 102 does move us towards IFRS. The good news is it doesn't go all the way and it's not as hard, not as complex. The new standard introduces the concept of basic and non-basic financial instruments, and I guess people can probably guess what that means. Basic ones are simple ones, examples being cash, trade debtors and creditors, most loans, things like that. Non-basic ones will be more complex loans, for example convertible loans, preference shares and also derivatives, things like that. Basic financial instruments are just carried at cost, amortized cost, but in effect in the vast majority of cases that will just be their face value. Possibly discounted, but that will be rare. Non-basic ones, though, do need to be carried at fair value, so that will require some additional work in terms of determining what those fair values are, and it will also create additional volatility in the profit and loss as those valuations change, and that goes through the P&L. Very quickly, some other changes that are very significant if they affect you. And I see one of the questions is on this, but they will affect a very small number of entities. So grant income previously had to be spread over the period to which it related in effect, which is the accruals method. But now we're allowed to use the performance method, which essentially means if you have delivered on whatever promises you made to get the grant, then you can recognise it there and then. So typically that will make it possible to recognise grant income more quickly. And actually we had a client that early adopted FRS 102 for the sole reason of being able to do that. Biological assets, so that's really crops and livestock, stuff like that. Historically had to be at fair value. There's now an option of fair value or cost. And finally, just touch on defined benefit pension schemes. They're a pretty rare beast these days. And so just be aware the rules are different. So if that applies to you, it's something that you should look into. But I won't spend time on it today because it's going to affect very, very few people. Finally, Alex mentioned format and language of the financial statements. In the first year of adoption, there's a requirement to effectively reconcile the profit under old GAAP to the profit under new GAAP. and more on that from Alex a bit later, I think. We also go on to IFRS style accounts, so things like the cash flow statement will look quite different, and there's a requirement for a statement of changes in equity, which is an entirely new requirement on the UK GAAP. A lot of the terminology changes in the rules, so we introduce the income statement instead of the profit and loss account. Debtors become receivables, creditors become payables, etc., etc. However, those aren't mandatory. It's the new standard is written in that language, which is essentially IFRS language, or American if you prefer. But it's not required to use the new language. So it'll be interesting to see whether people do or carry on, using things like profit and loss account, debtors and creditors, etc. Finally, the accounting policies will probably need a rewrite because they won't be compliant with the new GAAP. So just to summarise the key areas and where they might affect profits, there's half a dozen points on the screen here where I think in many cases, if of course they apply to you, they will affect profit. Could of course go in either direction, and some of them are short-term effects that then reverse. But be interesting now, having heard what you've heard, if we perhaps rerun the second poll and see whether more people think they might be affected or not. We're just waiting for some votes to come in. They're coming in quite thick and fast now. Thank you. Got about 2/3 of you voting, and yeah, almost all now. So interestingly, we now have a significant minority of people thinking their profits will decrease. I think it was less than 10% the first time around. It's now just over 1/3. Still the majority think they'll stay the same, but a less strong majority and a small minority think they will increase. Okay, so I will hand back to Alex, who will run through the rest of the webinar.
Okay, thanks, Alan. Before we go on to some more detail of the changes brought in by FRS 102, a couple of comments about tax. Now, neither Alan nor myself are tax experts, so we're not going to talk about tax too much. However, I think, as Alan has already alluded, there will be some changes to tax as a result of the implementation of the new standard. As we've seen so far, there will be areas where tax numbers change, sometimes because actual profits are higher or lower, typically lower as a result of the new rules. So, for example, if you're required to bring in a provision for holiday pay, then profits will reduce and consequently the amount of tax paid will reduce. But also where something called deferred tax will come in far more than it has done in the past. So at the moment, typically where you revalue an investment property, you don't provide for deferred tax. In the future, you will. So you actually make an allowance at the time you do the revaluation for the tax that you would pay when the property was sold, and that's going to obviously increase the tax charge in a set of accounts. Alan's mentioned a couple of others here, so things like lease incentives, the different way of spreading a rent-free period, for example, will change the actual profit reported. I've mentioned holiday pay accruals. Grant income could be very significant. If you recognise grant income upfront and much earlier, then the corporation tax will be payable on that grant income in the same year as you recognise the income. So that could advance corporation tax payable by several years. And I've mentioned investment property already. Other tax accounting changes, I think we've mentioned these. Business combinations will also lead to more deferred tax because of the different ways of amortizing the various intangibles that you have. Okay, so I'm going to now briefly talk about the new small companies regime. What we've discussed so far only applies currently to those companies which are either defined as medium size or large under the Companies Act rules in the UK. In the past, we've had different rules for small companies, and that will continue for 1 year at least. 2015 and years beginning on or after the 1st of January 2015, the small companies will still be allowed to use the financial reporting standard for smaller entities. The thresholds have changed slightly, they've gone up a bit, but essentially we're talking about a company with turnover income of less than about 10 million, 8 million pounds or so, various asset criteria, and employing less than 50 people. However, the good news that you might think that you can keep the financial reporting standard for smaller entities doesn't last for long. From the 1st of January 2016, the FRISI, financial reporting standard for smaller entities, goes, and from then on, the small companies will be required to use FRS 102 effectively, although there will be reduced disclosure requirements for small companies. As I've mentioned earlier, micro entities will still be allowed to use FRS 105. We've had a question in which I'll just pick up at this point in time because I think it's relevant here. Does the requirement to accrue for unused holiday apply to small companies using the FRISI? It's an interesting question actually, because arguably we should have been accruing for holiday pay accruals in the past. As Alan mentioned, typically this hasn't been done unless a company's been looking for a way to reduce its tax liability. However, technically speaking, there's nothing in the FRISI at the moment which says that you must do it. So the answer to the question is no, a company using the FRISI doesn't have to do that, albeit that the FRISI is not actually going to last a whole lot longer. Therefore, you might get a year's grace on that, but you'll probably have to do it eventually. The thing worth mentioning on that, of course, is that you only need to provide for it if it's what we would define as material or significant enough to the financial statements. Okay, so moving on then, so preparing for the change. I think as part of this, all companies, all entities really will need to look at what they need to do. All companies, and this small, medium and large companies and other entities as well, so this applies to charities, it applies to limited liability partnerships and other types of entity, will need to look at whether the changes are going to really apply to them. Obviously format changes will apply to everybody, but people will need to look at whether some of the changes to the accounting rules will actually apply to them. There'll obviously be an information gathering process, and people will need to look to see whether their systems and software can deal with the changes, especially if they're producing year-end financial statements themselves rather than having someone like James Cooper Creston producing them. I think it's also going to be important to work out a timetable for looking at the changes and agree who's going to do what. Obviously, we are very happy to help our clients implement this, but what we don't want to do is get to the date that we have to prepare the accounts and find out that actually nobody's done what's required. So in terms of the execution then, there are a number of things that will need to be done. As I mentioned earlier, the comparative period profit and loss account will also need to be converted to accounting under the new rules, but we'll also need to go right back to the beginning of that comparative period and convert the opening balance sheet as well, so that we have a starting point under the new rules. So if we move on to the next slide, working with a 31st of March 2016 year end, we can sort of see this illustrated. On this diagram, obviously our year to 31st of March 2016 will fall into the new FRS 102 rules, so that period will be prepared under FRS 102. However, as I mentioned, the comparative period, which was previously prepared under old UK GAAP up to the 31st of March 2015, will also need to be redone under the new rules, and we'll need to do an opening balance sheet at the 1st of April 2014 to enable us to have a starting point under the new rules. So I think another word that's been mentioned so far today that we haven't really focused on is what's known as the transition date. In this example, the transition date is the 1st of April 2014, so effectively 2 years beforehand. And where Alan talked about sort of things like business combinations where you have to go back to the transition date, or a new lease incentive where you have to go back to the transition date. In this example, it would be the 1st of April 2014 you would have to go back to. So if you bought a business in that 2-year period, you would have to be working out the effect of that acquisition under the new rules. Okay, so moving on to another diagram. This one is at the same year end, but what it's saying is for the comparative period, what we're required to do is come up with a reconciliation of the results and the balance sheet position under the old rules, comparing that to the position reported under the new rules, and there'll be a note in the first year of adoption which shows that effect. So effectively you're saying what the differences are and why the changes have happened on a line-by-line basis. So just before we finish, just to recap really some areas for early consideration. Obviously all companies are going to have a transition process, but things that you start needing to think about at an early stage are things like fixed asset values. Alan mentioned that you can actually now, at the date of conversion, you can revalue certain fixed assets if you want to, and then use that valuation as the deemed cost going forward. Clearly, if you're going to do that, you're going to need to get a valuation carried out for the asset, or at least have an idea of what the value might be. Things like financial instruments. If, for example, you have forward exchange contracts, you're going to need to know the value of those contracts, not just at your first year end. So in the previous example, the 31st of March 2016, but you'll need to know the value at the transition date, so the 1st of April 2014, and also the 31st of March 2015. As I've mentioned, acquisitions and buying companies could have a significant effect. The requirement to look in far more detail at the intangible assets acquired will mean that more work is required. And if you've had one of those acquisitions between your transition date and the first year end, you will need to revisit that acquisition and work out what it is that you've acquired. And holiday accrual calculation, some systems might retain that information, but it might be that the information you need gets lost if you don't do it at the time. So things like holiday accruals and the information needed to calculate them might well be required at the various dates. And things like software. If you're going to be producing accounts yourself, then obviously you will need to be working out how you're going to do that, whether you still do it in-house, if you've got Word templates or Excel templates, updating them, or whether now is a good time to outsource that preparation. In summary then, FRS 102 brings in some very key changes to UK accounting compared to the existing UK GAAP that we have. It will impact most non-micro UK companies, and it may well reduce profits for a lot of different entities in a lot of different ways. Now is really the time to start thinking about this. talking to the various individuals involved, not just within a company, but for example, if you have bank debt and covenants attached to that, it might well be necessary, for example, to talk to the bank about those covenants, just to make sure that everybody's aware what's going to happen. Obviously, draw up a transition plan and start acting now. So that brings to a close the formal bit of our webinar. We've got a few minutes left, I think, where we can take a couple of questions. I think we've had a couple come in already, and I think hopefully I've answered one of those. Another question's come in on the basis the FRISI will be abolished from 2016 and small companies will then adopt a reduced disclosure FRS 102. I assume small companies will also have to adopt the change to terminology. Alan, can you cover that one?
So two things to remember here. If the company is not micro, then yes, it will need to adopt FRS 102. If it is micro, then it will instead adopt FRS 105, which is simpler still. To answer the question directly, though, you don't have to adopt any of the new terminology, regardless of whether it's FRS 102 or 105. The terminology is different under the new standards, but you don't have to use that terminology in your account. You will have to do the new formats, though. So things like the statement of change in equity and a different cash flow statement will definitely kick in.
Okay, thanks, Alan. Another question's come in. For a simplistic example, if the only difference between FRS 102 and the previous GAAP reporting was the holiday accrual, would the reconciliation solely identify the value of an accrual made at 1st of April, which was never made? Again, Alan, are you able to take this one?
Yes. What you will do there is you will look at what the accrual ought to have been at the transition date and also at the opening current year date, if you like, so that the date in the middle of the 2 years, and those two differences will be identified, and the difference between those will be the impact on the comparative P&L. But yeah, in essence, the answer to the question is yes.
Okay, thanks, Alan. I think we've got time for one more question, which we've got. It's a company who currently uses IFRS on a voluntary basis. They don't have to use it because they're a listed company, and they're asking, can they now switch back to FRS 102? And the answer to that one is, in most circumstances, yes, you can actually. If you've previously adopted IFRS on a voluntary basis, now is a situation where you could now change back to the UK GAAP accounting framework. There's a couple of intricacies surrounding that, but essentially the answer to that one is yes. Okay, so I think we're at the end of our time allowed for today. Thank you to everybody for listening, participating, and staying on this webinar. I think what we've done is really take you through in half an hour or so a very quick summary of a number of the key issues involved. And clearly for different companies there are going to be different issues, and the new rules will affect those companies in different ways. So please do speak to your normal contacts at James Cooper, Creston, if you want to discuss this further, and certainly it's something that we will be discussing with you, our clients, over the next year or so as these new rules start to affect different clients. If you want, of course, you can contact one of us and you will see our contact details on the screen in front of you. So thank you very much. And
Can I just say one other thing? Those of you who are on FRISI, we will be doing a webinar in a few weeks' time covering the changes to the new FRISI and then touching on where that will go once that FRISI is abolished in due course.
Thanks, Alan. I meant to say that earlier. So we will be doing more on small companies and the rules surrounding those. Thank you very much.